Wait, have you ever wondered how a small startup company suddenly transforms into a multi-million or even multi-billion dollar public company almost overnight? Think about it, just a few people working out in a small size office, and a few years later, they are now worth more than a country's GDP. For example, Nvidia in 2025, its market cap hit well over $4 trillion. That's nearly 10 times Malaysia's GDP in 2024. Mind-blowing, right? And behind stories like this lies one ultimate game changer in the business world that you will never learn from the classroom: the initial public offering, or IPO. But before that, if you are hunting for the next unicorn companies, like how Nvidia was only $12 per share back in 1999, or Meta, they were just $38 per share during its IPO in 2012, you can do that with Webull Malaysia, a stockbroker that is fully licensed and regulated by the Securities Commission Malaysia, and you can invest in newly listed stocks the moment they debut in the stock market. And while Malaysians can't directly participate in US IPO ballots, you can still capitalize on post-listing opportunities, as unicorns usually shine the brightest after listing. And here's the best part: Webull is giving out special rewards to get you started. You just have to deposit 5,000 ringgit and maintain it for 60 days, and you will receive a free 500 ringgit worth of Nvidia shares. And now, if you are looking for even more reward, there's also a share transfer reward campaign worth up to 6,000 ringgit. So just transfer your existing shares from other brokers and hold it in Webull until June 2026. So let's say you transfer 30,000 ringgit from your Rakuten or M Plus Global account, you will then receive 600 ringgit worth of Nvidia shares, but it will be paid out over 6 months to you lah. I mean, can't really complain much cause it's free money anyway. So if you transfer a higher amount, it will automatically upgrade you to another tier, all the way up to 6,000 ringgit worth of rewards. And remember, these rewards are exclusive to the followers of this channel, so use my exclusive code Z888 when you deposit. Alright, let's break it down. Almost every company started out the same way, either from a family business or a startup in a garage with a partner, or in my case, my bedroom. I mean, who needs a fancy office with no employees in the initial stage when there isn't any product to sell, right? At first, it's just survival mode with little to no profit. And then later on, the minimum viable product, or we call it the MVP, would start gaining traction, which then builds up the initial customer base. And with revision and improvement from all the customer feedback, eventually the revenue would start to roll in. And if you're lucky enough to get venture capital or private equity at this point, your next step would then be scaling up the business. And that means hiring more employees, opening more branches, or investing in expensive technologies for the business. But at some point, when your business couldn't keep up with your shareholders' ever-growing expectation, even private investors would then struggle to give you more money to buy that super expensive factory to scale your business even further. So, if private investors can't help you, then why not turn towards the public? And that's where IPO comes in. It's like the company's big debut on the stock market, where they sell shares towards the public to raise billions and then take everything to the next level. And when a company goes for IPO, that doesn't mean they are selling the entire company to the public. Usually, it's just a portion of it. And this portion is what we call the public float, or outstanding shares. For example, some companies like Oriental Kopi or other recent listings only sold about 20 to 30% of their shares to the public, and the rest stays with the founders and their major insider investors. And now, when a company goes public, it's like opening the floodgates to a tsunami of cash, and suddenly businesses can use this money to fund game-changing projects like building multiple factories for businesses, or even opening thousands of restaurants for food chains. For example, again, Oriental Kopi went public in early January this year, becoming one of the most successful IPO in 2025, even though Bursa Malaysia was in bear market condition during the first half of this year. But then, they managed to raise more than the initial 184 million ringgit to open more restaurants and even set up a central kitchen. And right now, as of the recording of this video, their company is now worth more than 2.8 billion ringgit in terms of market cap, which they initially only targeted to be 880 million ringgit. So that's over 220% more than their initial expectation. Now, of course, other than receiving more money, IPO also acts as a liquidity event. You see, when the company is in private hands, most of their wealth is tied up in private shares that cannot be sold easily because private shares are unavailable on an open market and they usually require finding a buyer, getting board approval, and then going through various rounds and rounds of valuation process, basically trying to come up with a fair price for both the shareholders and new investors lah. And then eventually the legal due diligence process and all the messy paperwork. And it's a long and messy process with no guarantee of getting the deal through at a fair price. But with the IPO, these people who have invested in the company, such as founders, early employees, or even venture capitalists, can now sell their shares easily to the public at the price determined by the market itself. And often, this is at a much higher valuation. For example, Instacart, an online grocery delivery company, they went public in September 2023, but the founder, Apoorva Mehta, immediately sold off his shares in the same month and exited with $1.1 billion right after the IPO. Hence why you can see both raising funds and providing an exit strategy for the investors make IPOs a critical milestone for many growing companies. And now, this doesn't mean it's a rug pull. In legit IPOs, founders and early investors usually face a lockup period, typically 90 to 180 days, meaning they cannot just dump all their shares at once. It's a totally regulated and transparent process, not a quick cash out and run process, as companies must still go through a structured IPO process. So now, let me bring you through a typical IPO procedure. Let's say today OpenAI, which is basically ChatGPT's parent company, they want to go for an IPO. Well, firstly, they need to appoint underwriters. Typically big investment banks like Goldman Sachs, JP Morgan, and if it's listed in Bursa Malaysia, then they need to go for something like Maybank Investment Bank or even CIMB Investment Bank. And they are there to guide the company throughout the IPO journey, like giving the company a valuation to set a fair share price, handle mountains and mountains of paperwork, and finally, of course, selling the shares to institutional investors. And do you remember Tesla's stock market debut in 2010? There were more than just one single underwriter, as their business is just too big to be valued by one single bank. So next, the company and the underwriters have to then draft out an S1 registration statement. And this is basically a multiple 100-page prospectus document that tells everyone everything about your company, such as your business model, financials, management structure, risk, and even your plan for the cash that you receive from the IPO proceeds. And yeah, it's literally the document that would expose all your company's secrets to the public. And this document would then need to be approved by the Securities Commission SC Malaysia or the SEC if you're going public in the US market. But here's the thing, by going for an IPO and exposing your company to the public, you also risk your competitors knowing your exact business model and also the public knowing all your dirty secrets. I mean, take Webull as an example. They tried to go for an IPO back in 2019, but their S1 filing revealed massive losses and sketchy leadership spending, and this made potential unicorn investors freak out, and thus the whole IPO process just failed right before it even launched. But anyways, that's a story for another day. Once the S1 filing is approved, the next step is what we call a roadshow. Basically, this is where your company's executive directors will pitch to fund managers and also analysts worldwide on why they should invest in your company. It's basically like a global sales tour to hype up the market and make noises about your company. And at the same time, those underwriters will then have to do book building, which is basically to figure out the IPO's price based on how much investors are valuing your company. And this roadshow is a very important step. You see, Jack Ma, basically Alibaba, he went around the world pitching to thousands and even millions of investors, and everyone was hyped to the point that the IPO raised $25 billion, making it one of the largest IPO in history even until today. So as you can see, sales is very important. Anyways, once the roadshow is over, the underwriters that have been keeping notes on investor sentiment would then set the share price of the IPO. And when everything is ready, the IPO prospectus will launch with all the details about price per share, price to earnings multiples, ballot date, listing date, IPO process, etc. etc. Basically, everything you need to know about the particular IPO. And finally, the balloting period, where investors can apply through brokers like Maybank Investment Bank or even CIMB Investment Bank to submit their order based on the set IPO price. And after that, the issuing house, which is basically the advisor of the company stated on the prospectus, will then randomly choose to allocate shares to those who have subscribed. And like it or not, just because you have submitted your order, even if you are early, that doesn't guarantee that you will for sure get it, especially for hot IPOs like Oriental Kopi. And then finally, it's time for the moment everyone's been waiting for, listing day, where the company will celebrate by ringing the bell at Nasdaq or NYSE, or hitting the gong at places like Bursa Malaysia or Hong Kong Stock Exchange. And this signals that that company has finally achieved one of the biggest, if not the biggest step a company can make. Well, not exactly. You see, not all IPOs have a happy ending. Take Rivian, an electric vehicle company that went public in November 2021 as an example. During the IPO, they managed to raise nearly $12 billion, and big names like Amazon and Ford also backed them up, securing 100,000 delivery vehicles and getting access to Rivian's skateboard-shaped platform. And for a hot minute, it was worth more than Volkswagen Group. Pretty wild, right? But then suddenly there were production delays, supply chain issues, and even skyrocketing costs, which made them delay Amazon's order of 100,000 delivery vans. And in just a few short months, Rivian's stock price crashed by over 80%, wiping out billions in their stock market value. And now Rivian's stock price is about 83% lower than its initial IPO price. So yes, although going public often sounds like a wet dream to almost every entrepreneur, it's not always necessary for every business. I mean, take TikTok's ByteDance or even OpenAI as an example. They have chosen to stay private even though they are definitely capable of listing. Of course, the reason for staying private is not always the same, but it's usually simply because companies do not want to lose shareholder control. I mean, once a company is listed, every major decision like acquisitions, director changes, and even dividend payouts must be reported. And when it comes to certain decision-making process, it's no longer just a few top management making the decision. Sometimes the company needs to go through an annual general meeting or AGM with the shareholders just to vote for a decision. And most importantly, your financial results are always under a microscope, and when you miss, say, an earnings target, your stock price could just crash overnight. So, getting an IPO is not the perfect solution for every business. For some, it's the biggest achievement for them. But for others, staying private gives them more flexibility with less scrutiny and distractions. At the end of the day, going public is not about the finish line, but the start of a brand new stage in the marathon of building a long-lasting and profitable company. Thanks for watching.